Welcome, everybody, to the Agents of Impact call number 74, Catalyzing Growth Funds for Growth Firms in Africa. Let's see. I'm David Bank with Impact Alpha. It's great to see so many Agents of Impact on the call. We had, I think, over 250 RSVPs, and people are still showing up. As always, so many of you could have been on the call, and so why not go ahead and introduce yourselves in the chat. Taj has set the standard here, jumped in. Great, Taj. And say maybe where you're coming from, geographically, and also what your connection is to growth and investment in Africa. Let's see. The call is being recorded, so you've been duly notified, and there's a Q&A feature which you can use, and we'll try to work all your questions into the conversation and keep it going and bring them up at least towards the end. But so please do use that, and there's always also lively conversation in the chat as well. And if you have links to share, please do that as well. And we'll have a write-up and a roundup and a replay on Friday in the brief, and you can all pass that around to your friends as well. Let's say a quick hello to our guests, and then we'll jump in. From the Collaborative for Frontier Finance, Drew Van Glahn. Drew, welcome.
David, pleasure to be here. Thanks for hosting this.
Coming in from where, Drew?
I am dialing in from Washington, D.C. today.
And from Aruwa Capital Management, Adesuwa Okunbo, Rhodes. Welcome.
Hi, David.
And where are you this morning or this afternoon?
I'm in London today. Normally based in Lagos, but in London today. Back to Lagos tomorrow.
Well, welcome. And Evelyne Dioh, Simpa from WIC Capital. Welcome.
Hi, David. It's good to be back. I'm dialing in from Dakar, Senegal.
You're a veteran of these Agents of Impact calls, so welcome back. And Enyonam Kakane from Mirepa Investment Advisors. Welcome.
Thank you. Thank you very much. So I'm dialing in from Accra, Ghana. It's a pleasure to be here.
Thank you so much. And Victor and Ndiege from Kenya Climate Ventures. Welcome. You're on mute, Victor. So.
Great. Hi, everyone. This is Victor. I'm joining from Nairobi, Kenya.
And then my colleague Lucy Ndiege, also in Nairobi. Hi, Lucy.
Dialing in from Nairobi.
Lucy, your audio is low. I don't know if there's something you can do about that. Lucy's been at the Pension Fund Summit, the All Africa Pension Fund Summit in Kampala last week, and I wanted a quick report, Lucy, on what you saw there.
Sure. Is my audio?
Yeah,
okay?
That's better. Thank you. Yeah.
Okay, fantastic. So the All Africa Pension Fund Conference, happened last week. I think it's really remarkable, first of all, that the National Social Security Fund of Uganda was the convener. And we've been in touch with NSSF Uganda for a long time. One thing that we get from them a lot is pension funds in Africa are now realizing how important it is for them to sort of spur job creation, and especially for the youth on the continent. So the conference was a continuation of that conversation, and it was a way of putting African pensions in the room together with local funds.
Beautiful. And employment and youth employment, as you say, I think is one of the main drivers or outcomes, obviously, impact, shall we say, of this whole movement that you all are part of. Drew, help us just put a sort of frame around this. The Collaborative for Frontier Finance has brought many of these folks together, and Impact Alpha as well over the years. And I think the spur for this call was the recent report. So what's on your mind, and what are you trying to get out of the call today?
David, it's great to be here, and I'm really excited to be with the 4 fund managers that are on the call. They're going to be the real speakers to this. So I'll go quickly through a couple of thoughts for you. I mean, first, the collaborative, we work with about 100 of these, what we call growth funds across Africa. And I think part of the genesis of this call is we just put out a state of play report of what they're achieving, how they're approaching the marketplace, and what their needs are. And I hope today we'll have an opportunity to kind of hear on all sides of that. But what we're seeing is, there's been decades of reliance on banks in Africa and the North Middle East to address the gap in financing for small businesses. And what we're seeing, it's just not getting done the way it needs to be. There's plenty of data on that. No reason to go there. But what you'll hear today, I think, is from these 4 fund managers that out of this network, and they get fully funded themselves, they represent over $2 billion worth of monies going into the small business sector across Africa. And they're all doing it in ways that we haven't really seen done. Each one of these you'll hear are different models, which is really exciting. So what I'm really keen to hear today is really about what they're achieving, how they're achieving it, and then how we as a sector can be much more proactive in helping them, because getting at institutional capital, and Lucy was just talking about the Pension Fund Summit, which we co-sponsored with the Uganda NSSF last week, is what we really need to head towards. We've got to flow more institutional capital to these players. They're doing a great job, but we've really got to advance it all. So hopefully today's call will help kind of get some articulation on how they're doing it and why they really should be the growth focus for the development sector and for domestic institutional capital holders.
Let me just pause on the nomenclature, because you're talking about growth funds and growth firms, and I think that's a little bit of a reframe from what sometimes had been called small business or SME, small and medium-sized enterprises, or sometimes SGBs, small and growing businesses. But now the emphasis is on growth. What's that about?
Well, where we look at this is there's been a great effort over the last decades of supporting livelihoods through microfinance, and that's been wonderful. But those are really helping people stay above poverty, which is absolutely needed in many of these markets. But what really drives economies and job creation are businesses that start small and continue to grow. And so we're focused, and these funds are focused on enterprises that may start with a few employees and looking to get to scale. So their needs are somewhere as low sometimes as $20,000 up to $500,000 or even more. And you'll hear the whole spectrum today about it. So these are businesses that are purposely, intentionally trying to grow from where they are today. And in doing that, create jobs, create more professional jobs, create really the next generation of workforce and enterprises across Africa.
Great. Well, let's jump in. Adesuwa, you Aruwa is, I think, on its second fund, so you've been at this for a while. You've both a veteran, both of the raising of the money and the deploying of the money. So what do investors need to understand about the role of such growth companies in African economies?
Yeah, so thank you for having me. I'm David. It's a pleasure to be here. So at Aruwa, maybe just to give an intro, we're investing in early stage growth businesses that have, they've generated at least $500,000 to $1 million of annual revenue, and they're looking for between $1 to $3 million of gross capital. So these businesses that we're investing in are at an inflection point of their growth. They have proven their business model, they have existing demand for their products, but there's typically a capacity gap that they're trying to fill. So we're typically investing in working capital, we're typically investing in CapEx. So there's always a growth angle to these type of businesses. And what you can expect from these type of businesses is significant job creation. We've seen in our portfolio, we've deployed Fund 1, we're now deploying Fund 2. We've invested in 14 of these type of businesses, and we're supporting over 200,000 direct and indirect jobs from our portfolio. So job creation, and as Drew said, that is, dignified, fulfilling jobs being provided to typically underserved parts of the economy and of the country. We're seeing also formalized jobs, so more professional jobs. We're seeing informal segments of the market now having access to credit, having access to improved livelihoods. And also with Aruwa, we also have a very intentional gender lens where we're also investing in businesses that are either female founded, female led, or could be male founded or male led, but are providing a good or service to the female economy. So we're also being able to create bespoke products for underserved markets that otherwise would have probably not been able to, have access to capital. And we are intentionally investing with a gender lens because less than 2% of capital in Africa today is going to female entrepreneurs, even though Africa has the highest rate of female entrepreneurship in the world. So I guess, the growth funds and the businesses in this segment that we focus on, they're traditionally starved of capital from commercial banks. They're traditionally starved from capital from larger private equity funds who want to do much larger tickets. So there is a significant scarcity of capital to provide the necessary working capital, the necessary capex for a lot of these growth businesses, where the outcome is these type of businesses are generating 90% of employment in most of our markets. So job creation is a huge impact that we see, but also through our gender lens, improved gender equality, improved access to capital for overlooked female entrepreneurs as well.
Just so folks kind of can get a better sense of what we're talking about, just what kinds of companies in what kinds of fields
And what kind of sectors? Yeah, sure.
Yeah.
So we are typically investing in basic needs. So we're investing in businesses that are in sectors such as healthcare, sectors such as financial services and fintech, financial inclusion, sectors such as clean energy. So, 700 million people lack access to electricity. We want to be investing in the businesses that are providing alternative, cleaner solutions to address that. And also food. So access to essential consumer goods like food, agri-processing. These are the sectors that we focus on. So not luxuries or nice to haves, but the basic needs that the rapidly growing and urbanizing population in Africa would need over the next 30 to 50 years. Those are the sectors that we think provide, a defensible, non-cyclical portfolio.
And just this may be obvious to you, but maybe not to all of the people in the call. With such opportunities and such demand, why isn't capital more available to meet that demand? What are the bottlenecks?
Yeah, so I think it's really just the stage as to which the African, private equity landscape is at. Over the last 20 years, there was a lot of excitement with, the Africa Rising narrative, which meant a lot of capital got poured into a small handful of funds. And over time, those funds have only gotten bigger, right? They haven't gotten smaller. So we have a number of large funds on the continent that, are looking for large transaction sizes. But there are not a lot of, there are not a lot of companies on the continent that can absorb 20 million or 30 million or 40 million at once. And that's the typical ticket size of a majority of the of the private equity funds on the continent. But you do have a lot of companies that can absorb $1 to $2 million or $1 to $3 million. But unfortunately, there's not enough funds that are being invested in at that stage. Because my first fund, for example, was a $20 million fund. Not a lot of DFIs or institutional investors are investing in a $20 million fund. But that is kind of the right size that you need to do 10 $2 million investments, which is, the type of deal sizes that you see every day in our markets. So that lack of, I think there is a mismatch currently of the supply of capital and the demand for capital on the continent. And, there are a few initiatives now coming out, like the MasterCard Foundation Africa Growth Fund, that is investing in first-time fund managers, investing in gender lens fund managers. So we're seeing more initiatives now starting to address that mismatch. But unfortunately, we still have that mismatch, which means there is a huge scarcity of capital for SMEs in this kind of growth stage that I spoke about, because we just don't have the right fund sizes that make up the majority of the market today.
So it's not just more capital, it's kind of the right kind of capital, the right size of capital. And how do you make that work at Aruwa? Because the flip side of that is, bigger funds, give you more capacity. But as you say, then you get yourself in this bind of having to put out bigger ticket sizes. So you told us earlier that you don't really want to
Big
grow
fund.
up to be a huge fund. You want to stick with this segment. But how do you make that work as a business for Aruwa?
Yeah, no, so Fund One was a $20 million fund. As a first-time fund manager, you make the sacrifices that you need to make. I didn't get a salary for the first 5 years of Aruwa. You make the sacrifices you need to make to build the team, to, build your back office, do everything you need to do, because MasterCard Foundation was one of our investors. Visa Foundation was an anchor in Fund One. So we were able to kind of attract institutional capital eventually after starting with mobilizing local private capital. But we made it work, because I think for us, we're very intentional about, we're on the ground. We live in these markets. We live the problems that we're trying to solve through our company. So we have skin in the game in addressing these issues, because we want to create better ecosystems for our children and for ourselves. So we have skin in the game to make sure that we're addressing the opportunity with the right sizes of funds, and making sure that we are investing in a sustainable way, and in a way where we want funds that are going to make carry. We want funds that are going to do well. We want funds where we're paying the right price for assets, and these are businesses that can scale and that can generational wealth for our entrepreneurs. So at 20 million, we made it work. We made 11 investments. Fund two is now going to be a 50 million fund. We've got into a second close of 35 million, and it was anchored by MasterCard Foundation and Visa Foundation that re-upped. We've now have DFIs coming on board. So we have BII that's now come on board. We have EDFI that's now come on board. We have Ford Foundation from the US as an LP. And I guess with a $60 million fund, we have more capacity to follow on, much more than we would have in a $20 million fund. So we can really double down on our winners, protect our ownership, protect our governance rights. But as I said to you, we are very, very intentional about staying in this space where we bridge that VC and PE gap, where the businesses that we're investing in are too late for VC, but may not be techy enough for VC, but they're too small for the majority of the private equity firms. And as a firm, we think that this segment of the market really offers the best attractive risk-adjusted returns across the capital stack. So we want to stay there. If someone said I should come and raise a $500 million fund in Africa tomorrow, I would politely decline, and maybe raise five or seven different funds with different asset classes. But I think this segment is really where we see the demand on the ground, and it gives you the ability to really cherry pick the winners. And it gives you the ability to really, work with the founders that you want to work with. The problem, I think, and this is a contrarian view, but the problem that I think a lot of the larger funds on the continent have today is they're all looking at the same assets, which drives up prices, which affects valuations, which affects returns. For us, we're typically the only investor in most of our businesses, so a lot of our origination is proprietary. We're not overpaying for assets, so the return profile of my fund will be very different, I think, to some of the other funds in the market.
Great, great. I want to come back to this question about asset classes and types of capital. And you mentioned working capital, and I know you're interested in credit as well as equity. But let's hold that for a little bit later in the discussion, and move to Enyonam at Mirepa, and take yourself off mute, and there. And just give us a little bit of the landscape in Ghana. And also, I know that I think you've closed the fund. We've been tracking that along, and so congratulations on that. And just tell us how that process was for Mirepa.
Yes, that's correct. We have closed our fund. So we are an indigenous fund registered and licensed by the Securities and Exchange Commission of Ghana. And our fund is a local currency denominated fund in Ghana cedis. And our focus for the first fund is Ghanaian businesses, but businesses that have the capability to reach other regions and other markets as well. So that's our focus for this fund. And we also are targeting businesses that are in the basic and essential services as well. So we're looking at agribusinesses, we're looking at healthcare, education, financial services. And for each of these sectors, we are looking to see whether this is a company that is doing some light manufacturing or using technology to deliver their processes or to deliver their products and services. And we also strongly consider climate or clean tech, utilization within the business as well. So for our first fund, we raised mainly from the pension funds and local pension funds and the government fund of funds, which is a venture capital trust fund. And yes, we did require, our Securities and Exchange license before going on to securing the funds from the pension funds. But one of the key things for us was having the venture capital trust fund anchor the fund, and that helped to bring on board the pension funds as well. Being a first-time fund manager too, we needed to build trust with the pension funds because although there's regulation that required that they do pension funds, they do venture capital PE funds, the adoption wasn't that high, and many of them, were not putting capital into VC firms. So it took a lot of work. It took a lot of engagement, both directly from the team and then also at the association level, etc. So we needed to build trust with these pension funds. We needed to ensure that they could see our track record of having built businesses in Ghana and how we are applying that to the fund that we have and how we are applying that knowledge to building SMEs in Ghana, SMEs that can have impact regionally as well. So that's how it's been. We have a portfolio of 2 at the moment, both in the agribusiness sector, and closing a few more within the next few months.
Enyonam, how would you compare working with local versus foreign investors?
I'm sorry, can you ask the question again?
How would you compare working with local versus foreign investors?
Well, so we don't have any foreign investors in this fund, like I said, and for various reasons. Foreign investors, so one was the fact that we are a single country fund, and so for the foreign investors, that might be an issue where there's a risk. And at the time that we're raising this fund as well, there were a number of economic issues going on within the country. We're just going into the IMF program. There were uncertainties. The cedi was rapidly depreciating against the foreign currencies. So there was a lot of uncertainties, and so none of the DFIs really wanted, or foreign investors really wanted to, touch any fund that was coming from Ghana, especially one that had just a single country strategy as well.
It's interesting. You turned a kind of adversity into a victory by getting a local currency fund, which has all kinds of, I think, advantages for the kinds of businesses you can back, and also for being able to attract the local investors. Just tell us. You mentioned the devaluations in mind. Just tell us sort of why the currency issue is such a big issue.
Mm-hmm. Yeah, so I mean, most of our companies here are doing business and earning revenues in the local currency. And for a foreign investor who is investing in hard currency, if we are not earning revenues, if the investment is not earning revenue in hard currency, then it becomes very difficult to actually show, success and returns when it's time for us to, return capital to the investor. So that was one where it was very unpredictable as to what the currency would be by the time that we are done with with the investments within the next 5-10 years. It was very difficult to tell exactly what would have happened to the Ghana cedi at the time. Right now, it's sort of stabilized a bit. Everyone is wary and very observant about it. But what we also did, which goes back to what our strategy was, to focus on businesses that have regional international impact, businesses that have low dependence on foreign or imported inputs, and then businesses that have the capability to, earn in the hard currency because they are exporting or because they have customers that are paying them in foreign currency, in the dollar, for instance.
I see.
So yes, so that's very high on our assessments of the businesses.
And just one
or
more
you
question
should show the desire to, yeah.
Just one more question, because I remember hearing the story of all the work it took, as you said, not just to attract the local pension funds and the local investors, but really to educate them about the whole asset class, the whole opportunity, and just a lot of work to get to the point where Mirepa could raise money from those local pension funds. So that's, I think, a kind of, it stands up as a kind of model that others can follow now. So just, is there a story or two about meeting with the pension funds or meeting with the investors and what had to happen to get them to come aboard?
I think there are lots of stories, but
I mean, because
yeah,
they
there are
don't
lots of
even have an
stories, but
allocation in some cases for the kind of what I guess would be called alternative assets, right? They were mostly investing in government paper,
yes.
global stock equity, stock markets and things, not in local, small local funds like Mirepa.
Yes, that's correct. So we realized that there's an understanding gap. So we needed to also do some education for them to understand that, especially for the gatekeepers, the analysts, to understand that the way that you assess the government bonds and other investments that you do is not the same way that you assess a private equity venture capital fund. So there was a lot of education along the way while still meeting, management and the boards of the trustees. We did several presentations to the trustees, and then also to, in cases where there were occupational funds, we actually had to go down to, the managers of the occupational fund to do presentations, to them and try and get them to buy in. Yeah. So yeah, many stories along that line.
Great. Well, thank you. Drew, back to you. We've heard from from two fund managers now.
Thank you.
I think in the survey, you talked to like 100 of them, and I don't know how many exactly are in the CFF network, but what did what did you learn when you looked across the board about types of capital, local versus foreign investors, local currency versus dollars or hard currency? Just give us a little bit of the spectrum.
Well, let me answer it in a couple of ways. One, just what you're seeing with the two so far, and you'll see with the other two, is all of these funds, first of all, are locally based, 100% of them. So these are teams that are embedded in their economies. And 86% of the funds, one of the two principals, and they usually have two or three principals starting these funds, have prior business experience, which in small business finance is really relevant. It's nice to know finance, but if you don't understand about a business and what it takes to grow a business and hire people and deal with less mature structural operations, you're destined to have some challenges. So one of the things you're seeing with this group of fund managers is their deep knowledge of the local market and their deep knowledge of what it takes to excel in the local market. So that's probably the first founding thing that came out of our survey in many ways. Unlike in the developed markets, where many of them funds get started because they came out of a Goldman Sachs or wherever, and they had a salary base quite substantial, a lot better than what Adesuwa mentioned her last 5 years or a couple of years of zero income. They're using sweat equity. So almost every one of them are coming and arriving with a substantial amount of commitment to what they're doing. So when institutional investors show up, they're looking for capital commitments, but what they're underestimating is the amount of human capital and intent that they're all putting into their setting up of their funds, which to me, as a long-term investor, is worth a lot more than a few dollars that somebody put in out of their savings account because they got a good pay for the last 10 years in an investment bank. So that's what we're seeing in terms of who they are. In terms of the approaches, about 2/3 of them, and this is a question I think is coming up on the side here, are using alternative type structures as well. You're hearing people describe different businesses at different stages, and you'll hear that even more. So there isn't, like in banking, one working capital product that everybody gets based on the collateral that you have of your home. Here, they're looking at the businesses and the enterprises, and that's another important thing is, unlike traditional African banks, these fund managers are looking much more like the developed markets, private equity and venture capital investors that are looking at the business potential and the cash flows that are coming out of the business. So they're using those analytical tools and able to do that. So, but then they are structuring, and as I say, about 2/3 will use hybrid products or blended products of equity and debt or hybrid revenue-based type structures. So that's another thing that's coming out across all the data for the network. On the gender side, just to again call it up because it's very clear in this call. In 2024, 70% of the new funds set up in the last year or so are women-led. So we're seeing an increased movement, an intentional movement of including women into the marketplace, which again has not happened in the more traditional markets, as Adesuwa mentioned about the dearth of what's happening there. So we're seeing that inherent change as well, and with that, new ideas and new approaches. And the other thing that you're also seeing is all of these are focused on businesses that are relevant in their economies. They aren't chasing just pure high growth. We think this is going to be wonderful, but you're hearing everyone being very practical about growth potential, business potential, and demand in either local or regional markets. And again, I think this is something really important that's been missed by the international players is they keep thinking everybody has to be only an exporter. That's not bad. And I know in Aruwa Capital, they've definitely been very successful in finding companies with natural hedges in their business models. But there are so many that they would like to be doing and others would like to be doing that are, as Mirepa is mentioning, are domestically oriented, or at least we'll call it soft currency oriented.
Is there a problem? Adesuwa mentioned it about funds getting too big, and then on the other hand, though, some of the big institutional investors like to write big checks. It makes their transactions easier in some sense. So is there a problem getting bigger money into smaller funds?
So this is what we in the report we refer to as the hourglass dilemma. You have all this large capital trying to get down to all these bite-sized deals, and that you have this bottleneck in between of trying to make that happen. And again, we as a sector and development, world, we've really struggled with that issue. And so, yes, there is an inherent problem of moving big capital to small deals. And that's why these capital managers you're talking to today are playing that incredibly important role of being that part in the middle of the hourglass that then can take larger pools of capital and disperse it. But even then, as you heard from Adesuwa, the institutional capitals would love to be putting 20, 30, 50. I can tell you that one of the big development agencies says we're only going to do 100 million size funds in small business. But you've already heard people say that's a real struggle to do in terms of actually deploying the appropriate funds. So there is an education that is needed to say, how do we get there? And so this exposure and what you're providing today with this call is to say there are players that are doing it. They need sizes between anywhere from 5 million to 2 million to 10 million from institutional investors. That is definitely a trend that needs to happen. One of the things that is also developing alongside of this, though, is, and it's a question that's come up, and I thought I'd just bring it up, is this issue of fund to funds. Now, a number of these right now don't need monies from fund to funds, but some where they're still on the smaller side would benefit. And we're seeing now in Ghana, Chigaba, which will go to a first close soon, which is a fund to funds, which is purposely then going to finance these funds. So they're going to take even bigger pools of money and move it to these fund managers. So for some of the earlier stage or smaller growth funds, they will benefit from that. So early on, Lucy mentioned the efforts coming out of NSF Uganda. They too are now looking at setting up a fund of funds. Nyala Ventures, the FSDA agency, has put together. So there are a number of those that are trying to do. So that's one pathway. But indeed, we do need to get directly towards more of the pension funds, getting monies to these funds in sizes they can then manage to then make investments anywhere from, as we say, 20K up to $1 million. I don't know if that quite gets to your question, David.
No, that's great. And just to pause on Chigaba, because that comes up a lot. You mentioned it's a fund of funds based in Ghana, I believe, its idea is to sort of be a intermediary between the bigger money and the smaller funds. And why is that so unusual, or why is the success of Chigaba so important?
Well, what we're seeing is many of these funds, these growth funds that across Africa, are technically first-time fund managers in the traditional sense. So as what you're hearing from Mirepa and others, while they've got good experience in managing monies in different situations, understanding the businesses, the traditional investors are looking for larger funds and teams that have got a 10-year track record of actually deploying it. And we're still at a nascent stage in this kind of growth-oriented set of enterprises and growth stage set of funding. So there is what we refer to as a valley of perseverance, where these funds are trying to show they know what they're doing, raise monies at the same time, and give performance. And so during that stage, and for those smaller funds, the fund-to-fund vehicles offer another pathway at getting at institutional capital that these earlier stage or sub-fund economics, where they're only operating at, say, $5 to $10 million as the first fund, the fund-to-funds can get them monies that are more appropriate in size and more risk tolerant in capabilities than, say, a traditional institutional capital player.
Lucy, do you want to bring in Evelyne?
Sure. So, Evelyne, at WIC, we understand that you had to move from sourcing capital from a network of angel investors. Could you tell us that process, how it was, transitioning from angel investors to now raising capital from larger investors?
Thank you. So the fund that I manage is called WIC Capital. It's a gender-focused fund deploying capital in Senegal and Côte d'Ivoire. And the fund is backed by the WIC, the Women's Investment Club. So we never started really as an angels network, but as an investment club. And the first club was set up in 2016 in Senegal, with really the goal to pool capital from individuals in local markets and then go and raise more institutional money to deploy towards SMEs, specifically women-led SMEs. So at WIC Senegal, for example, we started with 4 founders in 2016. When we were ready to launch the fund in 2019, we were 80 investors into WIC Capital. And then we invited the WIC Côte d'Ivoire that was set up in 2018 to join us in the journey. So we have one fund serving the two clubs and two countries. We had a fund one that is now fully deployed. It was a 5 million fund. As Drew said, I think the best way to do it in our markets is to have these small pilot funds of 5 to 10 million, prove the strategy, and go and raise an institutional fund. And that's what we did. We had a 5 million fund. It included 1 million from the WIC members, from these individuals. And then we went on and raised capital from diverse sources. We had some DFI money in it from their market creation pools. We had funding from USAID. We had investments from fund of funds that were very intentional on SMEs. We had, for example, the Niala Venture Facility. We had Adafits, a fund that was set up by the Luxembourg Cooperation. And that's how we decided at some point that it would be super difficult to keep raising from that structure because it was a local vehicle in local currency, open-ended, and it was very difficult to attract more than what we had at that point. And now we are at the point where we are about to close a second fund of 30 million euros that we set up as an institutional fund structured in Mauritius with a parallel vehicle in Senegal, to keep attracting local capital, because we were lucky we still have this network that is backing the GP. We have some other pockets of local capital that are coming in for the second fund. But really, to summarize the journey, starting as a group that invested in the fund has been interesting in a way, because this network is very essential in our strategy, in the way we support our businesses, so in our value creation. It has been also an argument in our fundraising for Fund 2, being able to show that this network is actually very involved in the governance of our portfolio companies, in supporting through mentorship, coaching these entrepreneurs. Because I think one of the reasons why it has been challenging for institutions, specifically DFIs, to invest in SME funds, that one, they have been burnt in the past. SME investing is very specific. It is different from VC. It is different from traditional PE. It needs specific value creation processes. So us being able to show that we have a network of around 200 women that are executive women, very experienced women that are really hands-on with the management team in our businesses, has been a key argument in our fundraise. So now we are moving from 5 million to 20 million at first close and 30 million in a second close.
And how do you tailor your capital to meet the different needs of the businesses that you serve?
Sorry, I cannot hear you very well.
How do you tailor your capital or your financing to meet the needs of the businesses that you serve?
So by nature, we serve businesses that are in their early growth. These are generally businesses that generate less than 500,000 euros of revenue per year. So we deploy tickets. With Fund 2, we will deploy tickets up to 2 million euros. With Fund 1, we have deployed up to 500,000 euros. So these are smaller tickets when we compare it to private equity. For us, deploying equity was essential because equity allows you to be patient and to be really hands-on. So we talk a lot about patience and smart capital. But when you think about equity, there is still the challenge of liquidity, which is a key problematic in our markets for our industry. So we were thinking of how we could mix that equity with something that will generate liquidity for us. And so we systematically have a shareholder loan that comes with the equity, and we structure the whole as in a self-liquidating manner using revenue sharing, mostly revenue sharing mechanisms. Meaning when we invest, we have a certain grace period depending on the business, of the underlying business, and then we start taking a percent of their revenue, so that at the end of the holding period, we are able then to redeem our shares to the business. So the put is exercised on the business at the initial value if we are able to reach a target IRR. So that's the way we see it. it's in some way it is capping our returns and our upsides, but in another way it's allowing us also to secure liquidity. And I think, and to come back to what Drew was saying, the real problematic for us SME investors in Africa is actually liquidity. Because I think there is some intentional, for example, for our second fund, we were able to convince DFI, but the DFIs that had an impact pocket and that wanted to address SMEs. But the reality is that they are all asking themselves how, if the funds that they are investing in are the best way to reach their goals for SMEs. And the risk that we face is that at some point they might come back to the banks that were the traditional intermediaries. So I think one element that we could, as an ecosystem, handle, or one solution that we could make sure exists, is liquidity. How do we make sure that our businesses are graduating from one fund to another? Like maybe we Capital being able to exit to Aruwa being able to exit to a PE, etc. That's the only way I think that we, as an ecosystem, can keep that money flowing towards our SMEs and these real businesses that are the majority of our private sector.
Evelyne, can you just give us an example of a company in the portfolio, maybe one that you've seen move up through the stages of capital or the stages of growth? Just one of your portfolio company examples.
So we are still in Fund 1, but I can give an example because WIC, the club. So we have WIC Capital. WIC set up WIC Capital and also set up WIC Academy. That's our technical assistance facility. And it was set up with the intentionality to prepare the pipeline of WIC Capital and really strengthen this large number of women-led SMEs in our markets. We have supported quite a number through the WIC Academy of businesses. And we have one example of an entrepreneur that went through an acceleration of 6 months by the WIC Academy and then was funded by us, by our Fund 1. And the vision when we were, and the rationale when we were investing in that business, it's a snacking business using local cereals, local foods. The goal is really for this business to be able to graduate from us to a PE. Fund 1 being able to provide adequate technical assistance, also that the tailored technical assistance that they need to strengthen their go-to-market strategy and strengthen their production capacity, so that at some point they are able then to raise maybe a 5 million to get from another funds.
Great. Thank you, Evelyne. The hour is going by quickly, so let's move to Victor. Victor, what financing mechanisms or instruments have you been using that have turned out to be effective? And also, what kind of like non-financial support is needed for in your context?
Yeah, thank you very much. And let me take the opportunity to introduce Kenya Climate Ventures first.
Please.
So we are a climate-focused fund manager, licensed under the Capital Markets Authority in Kenya. And just like the other early stage funds, we are really focused on early growth stage enterprises, but then climate-focused enterprises. We invest in several sectors: energy, renewable energy, water, agroforestry, circularity, and agribusiness. And what has been useful for us is that, in addition to indicators around job creation and the financial performance of businesses, we're also looking at a number of environmental indicators that are actually building onto, the various commitments that, countries have made around reducing on, greenhouse gas emissions and contributing to a better climate. So, dealing with that segment of businesses, then we have had it important to have a blend of instruments, actually. And this is built on the fact that as an early stage fund manager, we also need to secure our cash flows. We need to be liquid enough to be able to, drive our business, but also to be patient to the kind of, the portfolio of enterprises that we want to see grow and attract more capital. So we've deployed, a combination of debt and equity, but also to give the businesses an opportunities to demonstrate that they are able to service their obligations, because that's an important track record for, follow-on financing for other investors that are in this market, and continuing to look at the kind of portfolio that we have. So in addition to commercial capitalization, we also have a technical assistance facility that is very key, and I want to emphasize this from the point of every other early stage fund manager probably looks at raising capital from pension funds, DFIs, foundations. I think it's also critical to mention that one of the hardest segments to actually raise is funds for technical assistance, because the DFIs are not ready to do so. The pension funds would not give you money for technical assistance, so you have to create this pool of funders that are actually appreciating the fact that the value chains and the market where we are investing as underserved markets require, some kind of managerial support to the enterprises that we then convert from pipeline into portfolio companies. And that's a whole commitment to be able to raise that kind of money. So over the years, we have been able to use part of our setup funds to set up a technical assistance facility, then that continues to be capitalized from time to time. And this is then given a more programmatic approach as opposed to a commercial raise approach. So in the recent past, we have been able to raise money into the technical assistance facility in a number of partnerships, with UNIDO, working with UNIDO to raise additional technical assistance facility funding from the adaptation fund. That is the most recent announced and approved program that is going to really support us to be able to raise climate adaptation pipeline and ensure that they are supported adequately to be able to, to be ready for financing. And so that's a critical segment for us. So a combination of both, capital raise and the raise for technical assistance funds is critical for the growth of these markets. The experience we have again had is that, most of the underserved demographics in terms of entrepreneurship are mostly the youth and women. And, the previous funds have already spoken about this. And it's not just a walk into the market to surface this. There is a lot of, unholding support that is then required. Other non-capital provision support that is required to unhold the youth and the women, so that demographic is not left. Drew already mentioned that there's an increase in the number of early stage funds that are actually managed by women. That's the same way we are seeing an increase in the number of enterprises that we are getting into the portfolio that are actually owned and managed by women. And just to give it as a clear example that the first 3 to 5 stars in our portfolio are actually women-owned and women-led enterprises. So that is what the effort of blending managerial support and capital.
Thanks, Victor. Could you give us some examples of these funds, of these businesses that you've mentioned, the women-led businesses?
Yeah, so I will give an example of 3 of them. So the first one is One Exotic EPZ, which is actually one of the market leaders in Kenya in the macadamia value chain. So we have been, it has been in our portfolio for the last 6 years. The first one was a small debt facility of about 50,000 USD local currency equivalent that we invested very early stage. And then it grew and attracted, a bit more grants and concessional capital from other investors and banks. But then we continued to stay because we needed to show, the ongoing commitment and help them build a track record. So we refinanced them to upgrade their, the factory so that they were able to take large orders of processing macadamia, but also now to begin, exploring and servicing the export market. So just during COVID, we invested another 402,000 USD. That's around 40 million Kenya shillings. That actually made them, increase their capacity to be able to serve the market better. I tell you, the three ladies are now also key in establishing the Nut Processors Association in Kenya today. And it's not just now exotic EPZ driving its business, but also influencing policy when it comes to how that value chain can actually improve for the best. Another example is, one that works with the outgrowers farmers to be able to, produce and process chili and indigenous vegetables, both for the local and export market. It's called Maize Foods. And this has also been in our portfolio for the last 4 years. And during this period, it has grown its revenues. It has grown its capacity to serve more, smallholder farmers. It has attracted additional financing, not only from impact investors like KCB, but also from the banks as well. So that's another woman-owned and led enterprise. And then there is a third one, which actually got into our portfolio 1.5 years ago. And what they're doing is they are distributing water filters. In Africa and many parts of other continents, mostly the rural areas, communities access surface water, and that comes with a lot of safety risks. So one of the ways of addressing that is to be able to enable households to access water filters, which are affordable and can be used and portable from place to place. And this business has actually demonstrated that, irrespective of whether you are serving the underserved markets or medium level kind of customers, it is important to give your product the kind of marketing and promotion that it actually requires to prove that there is value. And in this case, the value is in the safety of communities and families. So this has been very important. It is promoted by Dutch interest, but for us it's important because it's actually pioneering an hierarchy of within the market that would not otherwise be served if they didn't invest in that kind of product or service. So all these are businesses that we are trying to grow to the next stage, and possibly would grow into bigger interests that would not then need the support of KCB, but would need continued support of other competitive sources of capital once they are fully de-risked.
We're at the top of the hour. I'm going to make an executive decision that we're going to keep going because we've gathered so many great people here. There's no reason to break it up. Obviously, if you have to jump to something else, thank you for joining. But if you can stay, please do. And let's open it up now. There's a few questions that seem to be coming up. And one, Victor, and everybody else can jump in now. And please, everybody go off mute so we can have an open conversation, and just jump in as you will. But one of them is about the kind of non-financial assistance, the technical support, and that doesn't often get figured into into fund structures and can in some sense depress the returns from the fund. So how do you cover the costs? Or account for the costs of that kind of technical support. Victor, you could start, but anybody else can jump in.
Yeah, I just want to make a contribution. Maybe the other colleagues will also do. But I think it is generally, within a fundraising structure, it is very difficult to embed, technical assistance into the overall scheme, of a revenue structure. For example, for a fund like KCB. Because then it is money that is not easy to recover from, business performance generally at the portfolio level. What we have done is that we have separated these two segments. Yeah. So we have the usual fundraising for capital that we are currently, doing with our own revolving risk capital facility, but also trying to raise from the local pension funds. But we also specifically raised from foundations and donors and other donor funded programs, typically to get into the technical assistance facility. So it's either money that is contributed by that segment of funders, but we also accept the fact that there are other TA and business support and business service providers that exist within the market. And we have made it deliberate to partner with them so that they can service both our pipeline and portfolio. So it doesn't have to be money that is strictly channeled to Kenya Climate Ventures so that we can deliver TA, but it's also delivered through a partnership, both at pre-investment and post-investment level. So those two approaches have enabled us to, crowd in a critical mass of partners that can actually ensure that, our intention to grow the capacity for both our pipeline and portfolio is actually serviced accordingly. So that's how we have approached it, and it continues to take that shape also generally in the market because of most early stage fund managers like us are actually interested in de-risking. At this stage, it is very difficult to drive meaningful revenue that KCV can then use to be able to directly support its technical assistance facility. So that's another limitation that as an early stage fund manager will go to grow with over time. But we have also looked at it, even with the large funds and established fund managers, it's not quite easy to make the required margins that you can invest as a fund manager into technical assistance, because in most cases, even the management fees that are paid out of managing funds are rarely sufficient to to keep aside to drive a technical assistance wing of fund delivery. So that's how we have approached it over time. Maybe the others can also share their thoughts here.
Other thoughts on this technical assistance and how to cover the cost of that?
I would say that maybe the best way to do it is to set up a separate vehicle funded by your LPs as catalytic capital. It cannot come from the GP money.
Yeah.
Yeah.
Go ahead.
No, I was just going to say that we've been fortunate enough to have some of our LPs provide us with technical assistance to cover a lot of the things that are needed because in line with what Evelyne said about value creation, right? So you need to hire a CFO, you need to implement an accounting system, you need to do a go-to-market feasibility study for a new market. These are, things that, your capital probably can't provide because your capital is solely focused on working capital, solely focused on CapEx. So a lot of the value creation initiatives can be funded through technical assistance. And, we've been able to make the case for that from our LPs. So MasterCard Foundation, for example, EDFI have provided us with technical assistance pools.
So we've had to.
Go ahead.
Please go ahead. Sorry.
Yeah, so we've had to rely on third-party providers of technical assistance because we don't have that facility from our current LPs. So we have a few partners who are working in Ghana who have funds for technical assistance, both pre and post. But we are still in the market to, bring on board additional partners. So I'll be happy to reach out to some for some recommendations. Thank you, or for some introductions.
And David, I was just going to add on to it from a more collective perspective. About 86% of the funds in our survey intentionally look at providing technical support. And so let me go back one thing. There was a question about pipe. There is no problem with pipeline in this, and I think Adesuwa gave some macro numbers to address that. None of these funds have had a problem with. But that doesn't mean that these aren't small businesses that do need better operational systems, whatever capabilities it is. They are growing. They are sometimes a more immature business that needs it. And that's where this technical support is purposely being provided. Again, as I say, 86% provide post support in some form, either through a partner, directly through some technical support that they receive funding for, or some do it out of their own fund economics if they can. What's critical, though, is there's been another question asked. I just want to weave this in about blended finance. We have a very different perspective on blended finance. None of these fund managers you're talking to are purposely looking at making bad investments. They're making diversified portfolio because maybe some investments won't perform as well as they would like. Yes, that's traditional portfolio management. But this traditional view of let's de-risk their investment, they're already doing it by being in the market, by providing this technical support, knowing there's businesses, knowing the network, knowing the markets that they need to grow into. They're doing that in a way no one else has ever done it. And certainly not the way banks proactively or do not proactively do it. So when I think about blended finance, I think about monies being moved more towards technical support the enterprises. That's where the best use of this money is, not to say these fund managers are making bad investments and therefore need a 30% risk protection for investors. So the early stage capital should come in from the development players and domestic development organizations to support the portfolios that they're doing here. So that's just a big theme we see across where the capital really needs to go, and a little bit repositioning this whole discussion around blended finance to be much more about technical support, not about de-risking what are capable fund managers.
I love that, and we've heard that before, that support the enterprises and the funds will do fine, that makes a lot of sense. The other question that seems to come up a lot is liquidity, and Taj Eldridge asked this, whether we need new types of deployment and return models in order to focus on sustained scaled growth. So I guess the liquidity question is partly exits and but then more broadly return of capital. And Evelyne, I think it was your idea that you could hand off to each other and you could create an ecosystem that there was a scaling within the ecosystem. So, but just maybe share some thoughts about how to get over this liquidity challenge.
Maybe to answer to the question, I think he was asking if we should think about other ways of measuring success outside liquidity.
Okay.
That was a way. It's a question. I think it's difficult to. We will never be able to do without that liquidity. Like it's part of the industry. You invest, and that's a business model. You invest, and while investing, you are thinking about your liquidity events, whether it's though your whole profitability is dependent of your exit, whether you are kind of planning it as we do and preparing for it through a revenue sharing model that is exposing you to some upsides. But I think for emerging fund managers, they have to take that into account from their first fund. Liquidity is key, whatever your impact, and with your portfolio companies. Because if you do not have liquidity, like DPI is a main indicator for your fundraising. You will maybe raise a first small fund, but then without DPI, it will be challenging to raise your second and your third fund. So for sustainability, the liquidity element is key, and I really think that's a way that's something that we can address as a group of fund managers, and really start really collaborating and frankly collaborating, and maybe showing each other our pipeline, our portfolio, and like really starting to prepare. Like I would love for Aruwa to invest in one of my portfolio companies. I will reach out to you, Adesuwa. I'm sure you will be able to exit also to other GPs, but we really have to do it frankly.
Good. Maybe we'll solve the liquidity problem on this call itself. Just to stop on the acronym DPI, distribution of paid-in capital. Is that right? Yes. And other thoughts on liquidity, and then I have one more question that's coming up in the Q&A.
One quick comment on it is just the planning of it, because at the early stage, let's say you are raising your first fund, or you have just mobilized some setup funds that you need to deploy over time. I think the key aspect here that needs to be mastered by every investor is patience. Yeah. So the market does not actually behave according to the projections that we normally do at the beginning of the race. It has several challenges, and if you have investors that are patient enough to understand the kind of market where you're investing, there could be blended approaches to ensure that the emerging fund managers actually have enough liquidity to be able to carry out their businesses and continue continue to impact. So I don't think it's about what kind of margins. I think it's about the stage of it's also about the market that we are trying to address. It takes much longer to be able to demonstrate the kind of cash flow that would define sustainability from a pure commercial sense of evaluation.
The other question that seemed to be coming up, and this goes to the fund of funds and other sort of levels of intermediation, is, doesn't that increase the fees, and does the capital get diluted as it comes down through all the levels? And I know people have thought a lot about that, and funds of funds go in and out of favor for all the reasons that we know. But is that something, is that a problem, that it's all going to the managers not getting down to the ground?
What we've seen, David, from a broader ecosystem perspective is, one, if you look at the history of the microfinance sector over time, many of them are funded, the microfinance across Africa and other markets are funded by global fund-to-fund vehicles. So there's plenty of track record of that getting done, and they're being done effectively. And what we're at a more nascent situation with the small business growth oriented funds. So we are evolving, and what we have been coaching, and we've now starting to see this is an ecosystem question on the fund of funds. Right now, they're providing a development to the sector that soon won't need this bridging capital the way we've described, because they will start getting, as Aruwa Capital is, to 50 million and more. And therefore, they won't need a fund of funds to get them the capital. As Evelyne was saying about, at the early stage, it helps them to work at smaller dollar amounts, and therefore fund of funds are a good vehicle. So what's happening is the development players, and people like the Growth Firm Alliance, which is a collaboration of a number of foundations, are purposely subsidizing some of those fees because they know it's part of the ecosystem building as they go through achieving fund economics. But as everybody gets bigger, fund economics will be able to carry it. In managing a fund of funds, you don't need a big staff. So your economics are not that challenging once you yourself get to scale. So I think if we can bridge it with, and again, this is a better use of blended capital, is subsidizing that side of it, the institutional capital through the fund of funds. So that's another better use of quote unquote development / blended capital.
Great. And then no call would be complete these days without a question about AI. And so one of the questions is, on operational management and risks, how do you integrate AI tools to ease processes and lower costs? Is that something you all have thought about?
I think it's still early days for us, but we are incorporating AI into kind of email management, meeting notes management, helping our analysts just be a little bit more time efficient. But I don't think AI is going to replace what we need to do in terms of analyzing businesses. And, it's a very relationship driven business. You need to be comfortable with the entrepreneur. You need to, so I think it can help enhance processes to some extent. But I think we're still early to see how that's proven in an industry like ours that's very people and relationship driven.
Is it showing up in portfolio companies' operations?
Well, it's showing up in business use cases. So we've seen AI helping enhance precision agriculture, for example. We've seen AI helping enhance credit scoring and lending activities. We've seen AI helping with, precision medicine. So we're seeing it in use cases within companies. But yeah, I think as an industry, is in a private equity and venture capital industry where it can help to, I don't think it's going to replace me having an analyst yet. But maybe one day. Maybe one day.
I think we have to adopt it very fast. I just came from SME Ventures in Zurich, and KPMG did a presentation where they surveyed, I think, 50 PE funds and showing how they're using AI across their processes, from pipeline management to doing the DDs, specifically everything around market DD, value creation, and how it's reducing their timelines and the processes. So, for example, a market study that you would do in 2 weeks, being able to deliver that in 2 days or 3 days, with the usual risk, of course, the models are hallucinating sometimes. At some point, ChatGPT is speaking to you, so confirming your biases, and so highlighting the necessity to train the teams on the best way to generate smart prompts that are efficient. But I think definitely that's something that we have to integrate. And at some point, it will allow us to be efficient in our HR, I think. I think AI can replace analysts, and us focusing maybe on bringing on more senior staff. Yeah, the industry is moving and is definitely using AI already. So I'm personally looking into ways of training my teams on the prompt thing. Yeah.
Great, great. Well, I want to give each of you a chance to have a very short sort of final thought, and maybe take the chance with the folks that are on the call for what do you need, and what's your kind of call to action, but also what's your ask, if you could get some help in going the next step in your own journey. So I don't know who wants to jump in. I don't know if I prepped you to have a final thought, but who wants to go first?
I'm happy to go first. So I guess my call to action is just to back more first-time fund managers, because we can't keep on doing the same thing and expecting different results. So there has to be some innovation in how we think about right-sizing the funds that we're investing into. So the supply side has to catch up with the demand side. So my call to action is back more first-time fund managers, back more emerging fund managers, back more female fund managers. We do a study every year on the female fund managers in Africa. And when I started Aruwa, it was only 10 female-led and managed funds in the whole of Africa that had reached a final close. That number is now coming up to 40, but it's still not where it needs to be at all. And until we start backing a more diverse pool of capital allocators, again, we can't keep on doing the same thing and expecting different results. So I think my call to action is innovation and right sizing of the demand that we see on the ground.
Beautiful, beautiful.
Yeah, I think a quick one from my side, just two items. One is investors to keep pioneering, keep looking at new, emerging fund managers. As we had said, it is only possible to grow in more and crowd in more fund managers. Race with the ones that are coming up. Successful ones can already do it and have already done it. So if we have to crowd in more and we have to maximize on the kind of impact that we want to see in these markets, one shoe fits all kind of arrangements in, our fundraising models, the typical track record that everybody would want to see, that is unchallenged only on what kind of margins are you bringing in the shortest time possible. I've always not worked for emerging fund managers like us. I mean, it requires a lot of effort to grow capacity. That's number one. Number two is just the fact that local capital needs to flow in much easily. That does not mean overlooking the track record, but it only means that the level of risk averse considerations into alternative investment need to be relooked at. And so the blend of these, from different capital sources should give us an opportunity to deploy more. So, fund managers that are deploying in local currency, I think it's important. The forex risks are just too high to manage. And so there is need to have local, capitalization coming in. Pension funds, I have always said that it is an opportunity. And just to give a flash on it is that, in Africa, almost like 15% of the African GDP is equivalent to what pension funds could do in alternative investments. That's a lot. I mean, if it's just a trial on one or two Aruwa, KCV, week, and it would still not drain the assets that you have. It will only demonstrate that it can work, and then it gives you an opportunity to invest more in your environment.
Great, thank you.
Yeah, so I would say that for Mirepa, and there might be others who haven't had foundations and other international LPs in their fund, for us looking at second fund as we wrap up deployment on this fund, we would need a lot more networking and warm introductions to foundations, family offices, and getting funds like us and others to the right partners who would be able to come on board to support our funds. That would be my addition to what Adesuwa and Victor have shared.
Great, great. Hopefully, this call may have accomplished a small part of that. So that's a good call to action. Evelyne?
My call to action is really towards allocation, the allocators. We need more Shigabas, more Nyalas, because so that these first time fund managers are able to close a fund. It's difficult to raise a fund without the DFIs, and I think they are not still ready to go into this space, to come into this space. We have a few DFIs that are investing in our fund too, but that say that they will not necessarily invest in another SME fund. So that's an issue. I think we need more Shigabas, more fund of funds that are properly funded to address these SMEs and to address these first-time fund managers. We need also more collaboration across geographies and across fund managers. So that would be my call to action.
Great, great. And Drew, you have a call to action?
I'll put them into three categories. Really, it's a summary of what you're hearing. We need more domestic or domestic-oriented LPs. You're hearing that across, be it institutional capitals or local or regional fund of funds, a la Chigaba or Nyala. So that's the first one. And that is a lot about education, and the value of this kind of call is really exposing. People still don't really understand who these funds are. So there's a lot of data and knowledge that needs to be shared with those folks to get them there. That's the first one. The second one is this issue about, and Sue mentioned this, which is we need more first-time managers. There is a huge need beyond it. We have 100 in our network. We believe there's probably another 100 out there that aren't even in our network yet. But we think there's at least 300 to 400 more of these kinds of funds that are needed across Africa, given the scale of demand and supply of good businesses. But what we need is early stage capital, like what the Growth Firm Alliance, what FMO is doing through their market creation, things like that, that help these early stage funds get up and running and deal with the early stage fund economic challenges that you've heard, the technical support that they initially need to start building out for their portfolios. So we need that early stage support capital. And then and FCDO and some others are also part of that solution as we're seeing it right now. And then third, and we're going to leave this aside for a future call, but it is one that will be out there as well, but it's kind of come up on the side a little bit, is currency. Many of these businesses will do much better when they're able to get at local currency or managed local currency. And I know people like the Sharper Center out of MIT are looking explicitly at small businesses and access to better currency mechanisms. The first place will be starting with pension funds that are domestically capitalized or local currency capitalized, but also how do we get the DFIs that Evelyne's mentioning, who have traditionally required hard currency returns. How do we help hedge some of that and deal with that? That'll be another big discussion at another time, but it is certainly one out there that fits into the liquidity discussion as another future one that we have to address.
Awesome. Well, thank you all so much. I think it's almost like commonplace now, but I think it's worth noting just how extraordinary it is to be able to have you all on a call from, and I'm out here in California, and all across the world, and all come together. And I know that there's challenges, but also just to see all of you here and marching through what I think CFF has called the Valley of Perseverance. So I salute the perseverance, and thank you all for joining, and thank everybody who's joined as a audience. We'll have, as I said, a write-up and a replay of this. So if you want to pass it around to your friends and colleagues, that would be great. We'll have that out on Friday, I believe. And also, I would be remiss not to say that if you want to keep following our coverage of growth funds and growth firms, you can subscribe to Impact Alpha. There's a free open newsletter if you want to sort of try it before you buy it. And we'll be on the case, and we appreciate the collaboration with Collaborative for Frontier Finance and with all of you, and we'll see you again soon, I hope. So thank you very much.
Thank you.
Bye. Thank you.
Bye.
Bye-bye.
Okay.